The majority of individuals in the market are currently making the worst move. They are watching their tech portfolios draw a line. They are reading the headlines of the Strait of Hormuz. And they are preparing to panic sell. And frankly, I understand it. Since you opened your app, everything is red. All of your instincts are to do something. Get out, stop the bleeding, sell. Yet this is what those people do not comprehend. The oil shock currently crushing tech stocks is no mere threat. To the persons who have been made acquainted with what I am about to present, it is the only greatest compounding opportunity of the past 10 years. This is how you will be able to have your money positioned so that this crisis does not ruin you. It actually gets you wealthier. The exact strategy, the exact instruments, and the one trigger number that will inform you when to move. Wait with me, and I have yet to tell you the best of it. I will begin with the actual dimensions of this, because I believe that the majority of the population is completely clueless. The Strait of Hormuz was virtually shut down on February 28, 2026. In the event you have not been introduced to the strait, here is what you must know. It is a slender passage between Oman and Iran. Only 21 miles along its narrowest path. And it carried about 20 million barrels of oil through it every single day before February 28th. That is about 20% of the entire world's petroleum consumption. Every single day. Through one channel. The International Energy Agency estimated the actual amount at almost 15 million barrels per day of crude oil alone in 2025. Approximately one-third of the world's crude oil trade. Put liquid natural gas over that, and you are staring at about a quarter of all seaborne oil trade on the planet going through an opening which is now virtually closed, according to the United Nations Trade Agency, UNCTAD. The number of ships that passed the strait declined to 6 in March, compared to about 130 in a day in February. A 95% reduction in traffic. In weeks. In March 2026, research published by the Dallas Federal Reserve estimated the shortage of supply at nearly 20% of world supply. And to place that in perspective, the 1973 Yom Kippur War took away approximately 6% of the global capacity. In 1979, the Iranian Revolution displaced an estimated 4%. This upheaval is 3 to 5 times greater than any oil shock in history caused by geopolitical factors. It was referred to by the IEA as the biggest supply shock ever to hit the world oil market. Not this decade. The biggest ever. Now is where your portfolio comes in. I would like to take you through this step by step because no one explains this step right. Oil surges never attack your tech stocks in one way. They strike them through 3 different channels. And when all 3 are operating simultaneously, that is when you have the type of drawdown that takes years to recover from. Channel 1 is the rate path. As oil shoots, so does inflation. As of the end of 2025, the Consumer Price Index of utility gas services was already at 10.8% year-over-year. Analysts were already predicting that a sustained disruption would add 0.8% to global inflation on top of that. Here is why that kills tech stocks in particular. Technology stocks are long-duration investments. Think of them as a bond with a very distant maturity date. Their values are based on future earnings, years, even decades out, discounted back to the present at an interest rate. That discount rate increases when inflation forces rates higher. And as the discount rate increases, the present value of those future earnings falls. The company does not need to do anything wrong. The math does it. The stock declines while the business is perfectly fine. Channel 2, cost of goods. Asia is the supplier of the hardware powering the AI economy. Apple is assembled in China. The chips NVIDIA makes are produced in Taiwan. Every piece of data center equipment moves through a supply chain that depends on shipping lines, bunker fuel, and freight insurance. All 3 of those costs have risen since February 28th, and margin pressure goes directly to earnings. The channel moving the most money is Channel 3. It is called sector rotation. And this is the one most retail investors are utterly in the dark about. An oil spike triggers a mechanical flight of long-only institutional capital, out of tech and into energy, defense, and commodities. Index allocators rebalance on volatility. It is not an opinion. It is a systematic, rules-driven flow that happens regardless of how any fund manager feels about tech. And when oil is sustained above 90, 2 to 4 percentage points of relative performance get lost to the rest of the market before the tape turns. The oil has been above $90 for over 50 days now. And this is where most people get it wrong. And it is costing them. They see the rotation happening, their tech positions hurt them, and then they try to time it. They buy the dip on technology declines. They buy energy stocks after they have already risen 20%. And they get whipsawed when the geopolitical premium later dissipates. That is not a plan. That is how you lose twice. All right, so let me give you the real numbers of where things stand as of today. As of mid-April 2026, the Nasdaq Composite had fallen almost 7% year-to-date. The Magnificent 7 stocks, tracked by the Round Hill Magnificent 7 ETF, were down 8.8% on the year. Microsoft had fallen over 20% from its late 2025 highs. As of April 18th, Nvidia was trading at $201.68, well below its previous highs, and analysts are calling Nvidia a sell-on news going into May earnings. That is the damage already done. But it is the forward risk that matters. If there is a second straight incident, or Gulf infrastructure is more broadly struck, WTI crude goes to at least $95 or higher. That scenario was flagged as a plausible near-term risk in analysis published just days ago. And at those oil levels, another 2 to 4 percentage points would be shaved off the Nasdaq in under a week. When tech is already down 20 to 25% from its late 2025 highs, a further move of 20 to 25% puts some high multiple names in very real pain. That is the 25% total drawdown case. And that is what this plan is built to cushion you from and make you money in the process. Here is where the practical comes in. 3 specific moves you should be making. Not on the next escalation. By then it will be too late. And the third move is the most important. Everything is built on it. Move 1. Directly shift your cash flow to dividend compounders. I want to give you a specific instrument here, not an abstract category. The Schwab U.S. Dividend Equity ETF, ticker SCHD. Here is why it matters right now. The market rotation data through April 2026 is unambiguous. Energy stocks are up over 22% since the beginning of the year. The iShares Global Energy ETF, IXC, was up almost 29% year-to-date through mid-April, when oil broke above $114 a barrel. Consumer defensives gained 13.3%. Industrials enjoyed over 16% gains. This is not speculation. This is where institutional money has already moved. SCHD gives you exposure to energy, consumer staples, financials, and healthcare at a 0.06% expense ratio. It currently yields around 3.45%. And here is the number I think is the most important in this entire video. The maximum drawdown in the entire history of SCHD is negative 10.88% in a single year. Think about that. In the single worst year in that fund's history, you lost less than 11 cents on the dollar. That is against the Nasdaq, which has seen drawdowns of 30, 40, and 50% on multiple occasions over the past 25 years. Here is exactly what you do with SCHD. You turn on automatic dividend reinvestment. And you do not touch it. That 3.45% yield, reinvested every quarter into additional shares, compounds at a rate that actually accelerates during market declines. Because every dividend reinvested is buying more shares at lower prices. A comparable high-dividend Vanguard fund delivered a 202% total return over 10 years versus 130% in higher-yielding, lower-growth alternatives. The compounding advantage over raw yield is real and measurable. And SCHD received nearly $19 billion in new inflows in the weeks following its March 2026 reconstitution alone. Institutional money already knows this. Move 2. Use energy gains to trim your highest multiple tech holdings. Here is the logic, and I want to walk through it carefully because the order matters. Energy stocks are already stretched. ExxonMobil is up 21.8% year-to-date. Chevron is up 21.8%. IXC, the global energy ETF, is up 29% in 4 months. If you rotated in early, you are sitting on real unrealized gains right now. The compounding strategy means you do not hold those gains forever, hoping oil stays above $113. In April 2026, the Atlantic Council published analysis making this point clearly. When the strait reopens and the geopolitical premium in crude unwinds, energy names priced at over $100 oil will give back a meaningful portion of those gains quickly. Here is the disciplined move. Take a slice of your energy position, the names up more than 20% in particular, and redeploy those proceeds into dividend compounders like SCHD, which now trade at a discount to the S&P 500. SCHD's current price-to-earnings ratio is around 20. The S&P 500 is trading at about 23. You are buying a quality-vetted, dividend-growing portfolio at a discount to the broader index, funded by profits from the exact sector that benefited from the crisis. You are not timing the market. You are rebalancing with the rotation. And that is not even the biggest part. The real move is still coming. Move 3. Set a target rebalancing trigger, not a date. A price. Most people say they will rebalance when things calm down. That is not a trigger. That is wishful thinking. Here is a real trigger. WTI crude oil at $80 per barrel. That level is the pre-conflict trading range. Oil pulling back to $80 signals the geopolitical premium is deflating. And when that happens, two things occur at the same time. Energy stocks give back a portion of their gains. And tech stocks begin to recover as rate path pressure eases. That is your signal to take a portion of your dividend holding and redeploy into quality tech at recovery prices, while keeping the dividend compounding engine running, without shutting it off. Let me walk through what this looks like in actual numbers. Say you currently hold $10,000 across tech and energy. Your energy position has run up 20%, so that $5,000 has grown to $6,000. You take $1,000 of that profit and invest it into SCHD at today's discounted value. Dividends are reinvested into SCHD every quarter. Tech slides another 10%, but with each reinvestment, your SCHD position is buying more shares at lower prices. Then oil falls to $80, tech recovers. You rotate $1,500 from SCHD back into tech at recovery prices. You bought the dip, you collected dividends through the turmoil, and you rebalanced at both ends of the swing. That is the combination strategy, working in both directions simultaneously. I want to close with the historical case because I think this is what actually gives you the conviction to act when everything feels frightening. The last time we saw anything resembling a geopolitical oil shock paired with inflation like this was the 1970s. And the data from that period is sobering. The Dow Jones Industrial Average delivered virtually no nominal return for that entire decade. The Consumer Price Index rose 186.4% between 1968 and 1983. An average annual growth rate of 7.3%, with energy prices rising 9.9% per year. The investors who built wealth through that environment were not the ones chasing the hot sector when it was hot. They owned cash-flowing businesses, they accumulated and reinvested dividends, and they rebalanced when the macro environment shifted. Here is the other side of that. In the Fidelity Market Outlook released in April 2026, something was very clear. The S&P 500's maximum drawdown in response to the Iran conflict has stayed below 10%, because corporate earnings, not just AI earnings, have remained healthy. Fidelity's director of global macro research called the 45-month-old cyclical bull market not broken, but bent. The Magnificent Seven now trade at a forward price-to-earnings ratio of 25. That is not a bubble. That is a compressed valuation on companies whose underlying fundamentals remain intact. Recovery is in sight. The question is not whether tech recovers. The question is, will you have the buying power when it does? And that is exactly what the dividend compounding strategy is designed to preserve. The people who come out of this ahead are not smarter than everyone else. They are not luckier. They simply did not disrupt their compounding at the wrong moment. They set a system. They set a trigger. And they let the rotation work for them instead of against them. Now you know exactly how to do the same. If this helped you understand what is actually happening right now and what to do about it, hit like and subscribe. I cover strategies like this every week, built on real data and real mechanisms, not just opinions. And to see how this exact compounding method performed during the 2022 rate hike drawdown, that video is just ahead. It looks more like the current setup than most of you remember, and the playbook is nearly identical to the one you are now building.